So according to a story I just saw from Newsweek dated today, entitled Americans in Crisis Mode as Consumer Stress Hits 5-Year High. According to this Legal Shield, they did a report that says bankruptcy inquiries surged 17% in the third quarter of the year, continuing an upward trend that began in late 2021, 4 years ago, right? According to the Consumer Stress Legal Index report, it's up 4.4% between June and September of this year, capping off 7 consecutive months of increases and reaching its highest level since March of 2020. And the author says we're seeing families hit crisis mode heading into the holidays, especially around unsecured debt and rising housing costs. That's from the Matt Layton, the vice president, of Consumer Analytics at Legal Shield. The majority of Americans are missing out on the benefits of this growing economy, according to the author, but also the continued growth and rise in the stock market. Consumer surveys charting consumer confidence also continue to register declines, revealing widespread pessimism among households about their financial outlook and the economy as a whole. And it got me thinking, because I saw another story out of Zero Hedge we're going to jump into in a second, and that's the main topic for today. It got me thinking, do consumers ever really trigger a seismic event in markets? Do they bring down financial systems? I guess that's a rhetorical question I want you to get your input on. My thought, as I was kind of thinking through how I wanted to present this today to you, is that not really. I mean, look, if some guy goes out, overextends himself on a car lease, right, and his payments are too much to handle, he suffers a repo of the car, maybe a bankruptcy, okay, and maybe he's spending less money in the economy for a while because he doesn't have any money and he has terrible credit. Even, in a cumulative way, do the consumers that are suffering right now, quietly suffering in this country, which we know make up the bottom 90%, right? The wealth is held by the top, let's say 10% or less, probably even smaller percentage than that. And those are the ones in the stock market. So, do they really ever cause a takedown? The bottom 90%. They don't, because they're not participating in these markets. So who causes massive risk, underlying risk to a market? The last few days we've been covering, the banking system risk, right? Both from credit risk perspective and liquidity risk. How about the risk that the retail investors in the stock market pose to a market crash, which then ends up affecting everybody, even the bottom 90%, right? As more jobs dry up, people with money stop hiring, they start spending money in the economy, and everything goes full circle and gets worse and worse for the bottom 90%. Before I jump into the article from Zero Hedge today, as I always humbly ask, if you're not subscribed to the channel, I would really appreciate your subscription. Thank you to all the new subscribers come over in the last couple of weeks. Appreciate you being here. So out of Zero Hedge yesterday afternoon, there's an article entitled Retail Leverage Goes to Extremes, all right? And this is the kind of stuff that, from my layperson perspective, poses additional systemic risk, okay? And, a further risk above and beyond the risk that we know is building in the banking sector. So the article, I'm going to jump into a couple of the stats and I'll back into the point I want to make. Says, for prices to rise in the stock market, again, today, I think we made all-time high again in the Dow, all-time high in the S&P, I believe all-time high in the NASDAQ, right? So building on last week, continues to go up. I wouldn't expect that to change. As we know, the Jerome Powell will be out here on Wednesday afternoon, likely announcing a further rate cut, okay, of 25 basis points. We'll have to wait and see, but that's what appears to be the case, and then probably another rate cut in December. So there's nothing in the foreseeable future that's going to, let's say, stop the markets, from my perspective, from continuing to go up. Obviously, something can always come out of left field, black swan, something that's that is not that no one thought about. Okay, but for the most part, what this article says is, however, for prices, the market to keep rising, additional buying power is required. That makes sense, correct? And what it says is that clients are running low on investment cash. Okay, a lot of them are simply all in. It says, therefore, the additional buying power investors must turn for additional buying power. The investors must turn to leverage as prices continue to rise. The fear of missing out feeds the addiction for leverage, particularly when investor complacency to risk fades. Here we go. Margin debt, which reflects borrowed funds used to buy stocks, has surged to a record $1.13 trillion. According to FINRA, the 5-month spike in margin balances is the most aggressive since the last market peak. The deviation from the 48-month moving average is getting quite extreme, according to this article. It says, history makes this clear. Every time margin debt spikes sharply, markets don't keep rising. They top out or crash. The 2000 tech bubble, the 2008 housing collapse, the 2020 COVID sell-off were all preceded, it says, by a surge in borrowed money chasing gains. And it says, when many investors use leverage at once, the system becomes fragile. A simple pullback turns into a liquidation wave. ETFs must sell to rebalance. Options traders are forced to unwind positions. Margin accounts are closed. Selling begets more selling. Liquidity vanishes. Okay, so with that backstop, let me jump into some of these figures, how it's broken down, on the margin. Okay, and then we have, of course, the leverage. We have margin and leverage in the system. And again, I'm not coming at this from a negative perspective against stock market investors. Everyone has a right to invest and make a return, right? But here we talk about excessive, and it's just greed and it's just gambling. And when you have these people in the market, they're leveraging out, margining up, this is what produces a further layer of massive, risk to a financial system complete breakdown. So it says U.S. markets surged. Of course, this was a couple days ago on Friday. Again, all-time highs today. Beneath the surface, the environment remains fraught with risk, particularly regarding retail leverage. And what the author says is this time is not different. As we saw in 99, in 2021, you're watching another speculative cycle unfold in real time. Retail investors are piling in, emboldened by rising prices and fear of missing out. As stock indexes keep pushing higher, each new high incites more buying as investor caution fades. And he goes on to say, with regard to retail leverage, this gets really, it almost is mind-boggling. Regarding retail leverage, we're not talking about run-of-the-mill 2x or 3x leveraged products anymore. We're now seeing Wall Street provide 5x leverage products, to which this Jason Zweig via the Wall Street Journal took notice. And he says leverage is all the rage. You thought ETFs that double or triple the daily gains or losses on single stocks and cryptocurrencies were extreme. A spate of new filings seeks Security Exchange approval that would quintuple, the daily gains or losses on such stocks as Coinbase, Nvidia, Palantir, and Tesla. If assets fall sharply in a single day, the ETF could go to zero. And the new 5X ETFs that are out now, I don't know if they're new, but you got 5X AMD, 5X Amazon, 5X Coin, 5X Google, 5X Nvidia, 5X Palantir, 5X Tesla, 5X Bitcoin, Ether, Solana, and XRP, right? Of course, retail investors are potentially further increasing leverage also by buying the leverage products on margins. They can have margin where they're borrowing money, okay, not their money. They don't have the, let's say, the cash to put it in, to put it in the market, and then they're taking the margin debt and they're leveraging that out 2, 3, 5, sometimes more times than that. It says the real threat of leverage isn't in the tools themselves, it's how investors misuse them. Retail traders are no longer using leverage to hedge or manage risk, they're using it to gamble. This Jason Zweig pointed out that meme stocks have surged 363% year to date, and over 100 SPACs have raised nearly $22 billion, despite most of them now trading below their issue price. He says these are not rational bets on future cash flow. They are hopes pinned to momentum and hype. Leveraged ETFs are another blind spot, okay? And he says JP Morgan recently warned that these instruments can turn a market dip into a rout. Most investors poorly understand the mechanics. Leveraged ETFs, the 2, 3, and 5X we just talked about, must rebalance their holdings at the end of each trading day. That means they buy more of a rising market and sell more of a falling one. It's a built-in momentum amplifier. So I'd love to get your thoughts and comments on this topic because it seems to me that you've got, again, it's never really enough. We know that, greed is just, it's human nature. But it also, look at the subprime crisis, right? In 2008, it started with some greedy brokers, right? And debt in the system and leverage. And you always see this. Someone's going to comment, Matt, nothing's new under the sun, man. Why do we care? Because we're embarking upon another historical point here from the perspective of leverage in the stock market from retail investors and margin. Okay, and again, mom and pop that are in the bottom 90% that don't have a lot of assets may be indirectly in the market, okay, through their small little retirement plan or through their 401k or IRA, whatever it is. And when, the greedy bunch at the top, when it collapses, and it will, like it has, time after time, the losses and the pain flows to everybody else. The ones that aren't even really invested in the market, they're not enjoying the run up, but they're going to get smacked by the run down even further than they already are. So I just wanted to throw it out there today because it's when you see, again, the two divergent positions, hopefully it gives everybody a little bit of pause. And again, I'm not saying investing in the stock market, in and of itself is a greedy act, or not at all. I mean, everyone has a right to make their money the way they want to. But it's this excessiveness that always drives a complete collapse in the system. All right. Thanks for tuning in today. If you enjoy the content, leave me a like. If you're not subscribed, please subscribe. Leave your thoughts and comments. With that being said, I'll talk to you soon. Bye.